Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time. This week's topic, guys, is how to trade the market open in 30 minutes a day. We're going to talk about using pre-market charts, post-market charts, patterns in the pre-market, when not to get in early, when to get in early, how to add to those positions. I am not joking with you when I say this can make you money in 30 minutes a day. I'm not joking with you. From say 9:15 to 9:45. If you can scan a little in the pre-market, trade 15 minutes into the day, you can make a living in this business. Obviously, it takes time to get good. It takes time to succeed. And I highly recommend anybody that's new start with very, very small risk. $5 a trade, $10 a trade. The biggest problem people have is they come in with expectations that exceed their experience. They risk too much money too soon and they get their ass kicked. Don't do that. That aside, this is a great way you can make money in 30 minutes to an hour a day and do it consistently and profitably and professionally, which means you can repeat it, right? It's a repeatable process. So if you like these lectures, please click that like button, hammer that subscribe button. I am Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is how to trade the market open in 30 minutes a day. So recently we've been trying, I use that word lightly, trying to wait a little bit to take some trades. 5-10 minutes, wait till 9:35, 9:40, 9:45. Try to get 2-minute, 3-minute, and 5-minute charts instead of 1-minute charts. Now I'm going to reverse and change gears a little bit. And do the opposite. We're going to talk a little bit about pre-markets and post-markets and how to trade early on, or at least not to say trade early on, but how to set up your morning so that if you do want to trade early, you're prepared. And even if you don't want to trade early, this is extremely helpful because now you're going to get a better understanding of what a stock is likely going to do based upon early morning information, basing upon your gap list, basing upon your pre-market watch list, basing upon pre-market charts. So I'm going to roll it back a little. Again, I haven't talked about pre-market in a long while, because I haven't been trading pre-market as much as I used to. But a few trades in the last 2 weeks kind of brought this topic back to the forefront for me because we saw a couple that were so juicy and so nice. I thought, man, I need to start putting a little bit more focus back on that. So I hope that you guys find the lecture helpful and enjoyable. But before we get into the lecture, let's talk a little bit about when will the insanity stop? Somebody sent this to me recently, and it's just another person being foolish. I've been dreading this post for a while, but I finally must admit that I've lost a substantial portion of my life savings investing in #DJT. I was unable to continue this slide and sold the majority of my stake this afternoon at $26.55 per share. This is a disastrous fall, resulting in a loss of nearly $450,000 of my retirement savings. I am now forced to return to the workforce at age 76. Please, family, learn from my mistake and do not put everything into one stock. Well, the crappier part about this is now that stock is back at like $50 or whatever it was, literally, a month later? Literally, this post was April 15th. So you're talking 3.5 weeks later, this stock is back probably above where the person bought it, is my guess. I really don't know, but they certainly could have saved a lot. That's not the point. I don't care what the stock is, okay? I don't care what the stock is. If you're 76 years old, what in the effing world are you doing putting all your money in one company? I don't care if it's Apple. What if Apple does a 40% pullback and you need some of that money to retire? Now, again, if you're somebody that's got 10, 20, 30 million dollars, this probably isn't the end of the world for you. But this is, as this person says, quote, a substantial portion of my life savings. I mean, really? How did you earn that kind of money throughout your life and then be so foolish later? And I'm not trying to kick a person when they're down, but this is just, This is just silliness. You know what I mean? Like, come on, guys. You know, I'd say common sense is uncommon. I think this is an exemplary example of the lack of common sense that the average person shares. I don't care how excited you are about something. You're 76 years old. What are you doing? If you're 26, it's a bad idea, but you have a lifetime to recover. At 76, oh my God, I don't have the words for it. I don't have the words for it. So we will move on because this is just sad. And now they're going to have to go return to the workforce at 76 years old. Guys, I'll say this. Please, for the love of God, learn from these. I will not be around forever. And when will the insanity stop? Will stop when I'm not here anymore. So please read these and take them seriously. I know everyone thinks, not me, I could or would never do such a thing. I bet you this person thought the same thing. Tell me I'm wrong. You want to bet this person thought they were a level-headed, common sense person, and then they did this. That's usually how it happens. The people who think they have the most of it are the ones that are most inclined or, likely to do it. So please, please, please be careful. Okay? Please be careful. All right, let's dig in. Post-market charts. I'm stating the obvious. This is a very novice slide, but don't worry, we're going to get into some more important stuff in a minute. What is pre and post market trading? Well, it's trading outside of regular session, and the regular market session is 9:30 to 4 p.m. New York time. Okay, the market opens at 9:30, it closes at 4 p.m. The pre-market is 4 a.m. to 9:30 a.m. Eastern time, but the truth is it's really from about 8 to 9:30 because there's not a lot of activity from 4 a.m. to 8 o'clock. Okay, I'll repeat that. There's not a lot of activity from 4 a.m. to 8. It's typically from 8 to 9:30 and really starts to get juicy from 8:30 to 9:30 because there's usually some news reports around that time. Post-market is 4 to 8 p.m., but again, the majority of post-market is from 4 to 5 o'clock, 4 to 4:30 really. Post-market fades out very quickly, even for earnings. Usually like the first hour, 4:15 to 5, 4 to 5 is usually when it settles in. By the time you get to 5:30, 6 o'clock, there's not much left. So these are just basic guidelines. I think most of you know this information. So again, I'm not going to spend some time on it. Anyone can trade these sessions, but it's mostly institutions that partake in this stuff. Again, anyone can trade these sessions, but you'll likely see a lot more institutions trading these sessions. Let's take a quick look at these sessions. All right. Post-market chart. So this is an old chart of Amazon. As you can see, it hadn't split yet. Amazon, this is the normal market hours from 9:30 to 4. And then right here is a post-market session. You can see it right there. 1600 is 4 o'clock, and it goes to 8 o'clock right there. Now, in this particular case, or this particular day, Amazon actually traded okay, right, throughout that whole post-market, but most of the volume was right at the close. Then you get the regular session again, and then another post-market session. I just put 2 on there just so you could see it. That simple. Again, not going to spend a long time on it, but this is what it looks like if you combined the normal market hours with the post-market hours. So really, it's not quite 24-hour trading, but they're actually talking about 24-hour trading. So that's what that looks like. Let's move on quickly. This is what pre-market trading looks like, right? So if you take a look, this is regular hour trading on the left, and then right here is pre-market, okay? I don't know if I have this from 6 a.m. I may have taken the 6 a.m. off of this. This looks like it's only about 8 o'clock to 9:30, but nonetheless, you get the point. And you'll note, if you take the chart and move it to like 24 hours, which you'll see in a minute, it's just one big chart, right? You don't see the gaps because the gaps are happening in the pre and post market, right? There is actually no such thing as a gap. Let me say that again. There's actually no such thing as a gap. That gap is represented by a candlestick in the pre or post market. All right, and you'll see that here in a little bit. But this is a 24-hour chart. This is where you can just combine everything. All right, you take the regular hours, then you go post market, then you go pre-market, then you go regular hours, then you go post market. Got it? So right here, okay, on the left, all the way on the left, this is post market. There's a little bit of normal market hours here from like 3 o'clock to 4 right? But then this is post-market. This is pre-market from 4 a.m. to 9:30. This is normal market hours right here. Okay, normal market hours right here. And then this is post-market. So now this is a 24-hour chart. All right, now I say that because it's not actually 24 hours, right? The market does actually close for about what? 8 hours? Yeah, something like that. It closed from 8 p.m. to 4 a.m. So it's about 8 hours. So for those of you out there who are worried about them discussing 24-hour trading, don't worry about it. It's not going to change all that much. It's just not. It's not. Most people are still going to trade from 9:30 to 4 p.m. The vast majority are going to trade that time. Okay, but now you can see what it looks like strung together, right? You have a little bit of market hours, a little bit of post-market, a little pre-market, a little regular, a little post-market. And note, there's really no gaps there. I mean, I guess there's a little gap overnight here, but there's usually no gaps because it's filled out with candlesticks. So that's the basic stuff, but that's not why we're really here to talk about that. I just wanted to show it to you for the new people who have never seen pre and post market before. Okay, couple comments and attributes. Generally lower liquidity and volume, especially from 4 a.m. to 8 a.m. right? So pre and post market almost always has lower volume than the actual trading day. In fact, it always does. All right. I mean, I'm sure there's an exception, but 99% of the time, pre and post market has less volume than the actual trading day, which makes sense because it's also a shorter period of time. Spreadier and whippier, almost always spreadier and whippier. Why? Because it lacks liquidity. It lacks volume. So of course it's going to be spreadier. The market makers have to make money. And if there's lower volume, there's usually a higher spread because they need to make money. Okay? Can only use limit orders during this time. No stop limit orders. You can use market orders too. But my point I'm making is you can't put a stop market order in unless you use like a good till cancel plus or something like that you did during the market hours. So if you're trying to trade pre and post market, what is the lesson I'm trying to get to? The lesson is you have to manually stop yourself out. Let me repeat this. You have to manually stop yourself out, okay? Unless you've already put a good to cancel plus order in from, the normal market hours. But if you decide to buy a stock in the pre-market, say you buy a stock at 8:30 and you want to get out at 8:45 because it's not going well, you have to take yourself out of it, right? There's not a bracket because you're not allowed to use that type of an order during that time of the day, okay? Why does that make them more money? Because think about it like this, Sophia. When you have a stock with huge liquidity, what do you have? Gazillions of transactions. They make money off transactions. So if you make look at it like this. I'll put it in common sense terms. If you sell 1,000 pairs of jeans a day and you make $1 per pair, you make $1,000, right? $1 per pair because you sell 1,000 pairs. What if you sell one pair of jeans per day? Well, you need to have a much higher margin on that pair of jeans, don't you? Because you're only selling one pair of jeans. So when you have a stock that's trading, say, 100,000 shares a day versus 50 million shares a day, there's far fewer opportunities for the market makers to make money. So they're going to have to make more per transaction to make up for it. All right? So let's move along. But these are general attributes of pre and post market trading. But this last one is very, very, very important. You can't just get into a pre-market chart and expect, I'll set a stop market order and walk away. Can't do it. All right. So to Dennis earlier, you were asking about scanning. This is how I scan, right? I use TradeStation, and TradeStation has something called dollar gainers and dollar losers. And you can kind of see that here on the right, top right. It says equities all, exchange meaning New York, NASDAQ, Amex, etc. And it says dollar losers one day. It's the same on the left, but it's dollar gainers. So some stocks like MU and BAC and Citigroup always do a lot of pre-market volume. Why? Because they typically do a lot of normal market volume, right? Those types of stocks do lots of volume. All right, so when they do a lot of volume in the pre-market, it's not a huge deal because that's typical, that's normal for them, right? Our goal as traders is to find the stocks that don't normally do a lot of pre-market volume, but today they are. That is the key. All right. So take a stock that might normally do, I don't know, 20,000. And now you see it's doing 500,000. You're like, whoa. And some people ask me the question. They're like, well, how do you know how much a stock normally does? I said, I don't. I have an idea, but I know when Tiffany does 1.9 million shares in the pre-market, and that 1.9 million shares is more than its average daily volume, then that's a lot, isn't it? Common sense. Let me say it again. Common sense. So if a stock normally does 2 million shares per day and it's doing 1 million in the pre-market, I think you know that that's above average, isn't it? So you don't have to be Nostradamus or Einstein to figure this out. Okay? So why? Why is this so important? Because it shows a level of institutional commitment, and this is key, institutional commitment, right? Let's put a little underline there. Sorry, let's do it. Where's my underline? Right there, right? A level of institutional commitment. I like just messing around with this stuff in the middle of lectures. Right there. A level of institutional commitment. And guys, we talk about it all the time. All the time. You do not swim in front of the shark or the whale. You're the remora fish that rides on the back of the shark or the whale. You're a shrimp. And you ever see how many shrimp a whale eats in one time? A lot. You don't want to be that. So you want the institution to pave the way for you. They're like the snowplow. You just want to get behind the snowplow. You know what it's like? When the ambulance is going down the road and it flies by, you're like, sweet, I'm just going to get behind the ambulance, right? Which usually means above average trading ranges when there's above average pre-market volume. Okay? Normally it means above average range and volume. Okay? We still need a good gap in order to trade them though. Don't just say, oh my gosh, Tiffany's done 2 million pre-market shares. Well, that's not good enough. That sets Tiffany on my list, right? It puts it on my list. But it doesn't mean it's going to make the final list. It's a stock of interest at this point. Oh, wow, Tiffany's doing 1.9 million shares. Wow. But it is also gapping 29%. So that just merely stands it out, if that makes sense. It merely puts Tiffany in an area where I'm going to actually look at this, right? I'm not going to look at ATNX with 0 shares. It's up 37% on 0 pre-market volume. Yeah, no, I'm not interested in that. Where's the institutional commitment for that 37% gap up? Maybe it comes in later, maybe. But shit, if I did maybe, I'd have every stock here on the list if I did maybe. So I'm looking at the stocks that have exceptional, unusual pre-market volume. Exceptional, unusual pre-market volume. Okay? That's the key. PCG. 1.8 million shares. That's a lot of shares. Microsoft, 500,000 is a lot. Roku, 55,000. That's a lot. So these stand out to me. So I'm going to take a look at them. So let's take a look. What might this look like? Okay. Well, here we see a gap up on Amazon, right? Gaps over a pivot, then rips off the open with, I spelled this wrong. Whoopsie. There we go. With no entry equals, let's make that yellow. Annoying, right? So you have a nice consolidation the day before. It gaps up and doesn't really give you anything. Just kind of rips and just, that's it, right? And it doesn't look like much, but it's a $20 move, $22 move, okay? What do you do with this? You do this with this. Just take a look, stare at it, take a look. Now look at it. Totally different, isn't it? Completely different. 9:02 in the morning, 28 minutes before the market opens. Watch Amazon over 1905 for a small pre-market nibble. Market's extended though. By 9:26, 4 minutes before the market opens, faves, that's supposed to be Amazon, AMZN, over 1905. 2 minutes into the day, we just bought it. Why? Because Amazon immediately pulled back off the open and then ripped. It immediately pulled back. See it? See this line right here? Let me do this real fast. Okay, just bear with me. Right here. This line, let's make it pink. I don't know, maybe yellow is easier to see. I don't know. Maybe orange. There, orange. That line, okay? That line's the market open. That orange line is the market open. Note, Right there, it leaves a little bottoming tail and then rips. This is a 5-minute chart. So if you didn't nibble some in the pre-market or get in 1 or 2 minutes into the day, you weren't catching Amazon. That's it. And while it doesn't look like much, it was a $22 move off the low and about a $17 move off the high. We ended up giving this a $6 stop. I think this is actually $18.99. You'll see it on the next slide, I think. I made a lot of mistakes today, didn't I? All right, this is a $6 stop loss on a stock that moved $17. That's nearly 3 to 1. I'd say that's pretty good. But if you go back and you saw that, there's not much here. You're looking at it, you're like, not much I can do with it. But then you move to the pre-market, and what do you see? This amazing, incredible shakeout down to 1890. This beautiful consolidation happening right around 1905. You get a red bar right before the market opens, then it completely engulfs as soon as the market opens. High, low, rip. Okay? All because of pre-market data. And this was the Amazon trade, right? This was the Amazon trade. There it is. Got in right, see that red bar? That was the market open. That red bar is the market open. It dropped like $5 and immediately ripped, and we got in right then and there. Okay, we got in right then and there. I don't want to say no-brainer, but pretty close. Now, what? Yeah, this was a couple weeks ago. There's Amazon back at it again. So I showed you an Amazon chart, okay, from years ago. That Amazon pre-market chart I just showed you one slide ago was from 3 or 4 years ago. This was from 3 weeks ago, 2.5, 3 weeks ago. Same thing. It's pretty much the same thing, okay? This is all pre-market, and this is the market open right here. So you nibble some. You see that beautiful little shake right before the market opens. Beautiful. You nibble some pre-market at 177, maybe a third lot, half lot, third lot, half lot, and then maybe add on a 1-minute high. Put your stop down here, give it some wiggle. Bam. Things up $2 in the first 5 minutes of the day. Do you put a cap on how much the stock costs? Never. I never put a stock on how much a stock costs, but if you're a new trader, you probably shouldn't be trading $500, $1,000 stocks because they're too spready and whippy, and you could get hurt doing that. And also, if you're trading like $5 risk, you might have more than a $5 stop loss, like Amazon was a $6 stop loss. But this is a great example of a recent pre-market chart, okay, that had a beautiful shakeout just past 8 o'clock, stayed in a tight range in the pre-market, had a beautiful shakeout right before the market opened. You should be right around 925 to 930. 925 to 930, nibble, 1/3. Say your risk is $1,000, okay, and you're going to buy 1,000 shares of Amazon because it's $1 stop. Buy 300 to 500 shares. Why? Why? Because buying 300 to 500 shares, one, puts the stock on notice, like you're going to pay attention to it. Two, if it peekaboos a little bit lower, you can handle that. If you want to give it a little more room because it broke below 176, you can do that. And then when it comes back up, get full on it. That's exactly what happened on Amazon. You you nibble 1/3, right here at 177. And then when it puts in this bottoming tail, you know it's gold. It's gold after the bottoming tail. Get full. 30 seconds into the day, 1 minute into the day, get full. Nibble 1/3, maybe a half on the high side. If it rips off the open and gives you zero opportunity, at least you have a half lot. If it pulls back, at least you have extra room to give it. If it pulls back, leaves a bottoming tail, then you're going to add and get full right there 1 minute into the day. You already have a half. This pulls back, get full. This is money. This is gold. It's gold. Oh my gosh. Here's NVIDIA. This is, I don't know, 2 months ago, a month and a half ago. All right, I don't know why this says why people fail. It shouldn't. This should say NVIDIA pre-market chart. Okay? All right. Now, what's the deal? 4 a.m., There's your gap. You guys are all thinking it's a gap, but it's actually just stock moving up, consolidates, moves up, gets a little jiggy. But notice, right around 7 to 8 a.m., it starts to get tight. And then boom, shake, tight, tight, tight. So it's been tested, what, 4 times? One test right here. One test right here. Another test right here. And another test right there. 4 times it's been tested at 895-ish. And then chop, 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 rip. Chop, 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 rip. That's 904 is the entry, up to what, 925? It's a $21 move. $4 stop. Now, could you give this 899, 898? Sure you could. Sure you could. And maybe that's a better idea. It's held 900 so well, I'd give it $1 under that 899. Okay? Chop, 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 chop. Boom. No other entry there. There's no other entry there. Okay? Tested once, tested twice, tested 3, tested 4 times. Beautiful. Take a half lot. Maybe you get a tiny little opportunity. Maybe it holds there for 30 seconds or a minute. But this is what I mean by buying off the open, buying a 1-minute high. You already have a third to a half lot. If the stock just wiggles around a little bit, gives you a little bottoming tail like this did. Note the tiny, small bottoming tail. But that means it pulled back to like 901, 902. Great. When it comes back to 904, I'll get full. Put my stop onto the boom. Done. You're finished trading in 7 minutes, 8 minutes. By 9:40, you're done. So you know when I said in 30 minutes a day, this stock in the first 10 minutes moved up nearly $20 on a $5 stop loss. 4 to 1. You're done. And you can go back to Amazon. Amazon, you were done on Amazon, pretty much 5 minutes into the day. Okay? This stuff happens. You guys remember this? Microsoft, don't worry about the 6 cents from a $4 target part. This is a pre-market that we took. 424, I took this right off the open. We took this on like a 1-minute high because of the bottoming tail. Bottoming tail pre-market, bottoming tail pre. Now, is this as clean as the last 2? No, but 424, bottoming tail. We gave it a wide stop. We took basically a 1-minute high. Because it's holding this area. It has room to go higher on the daily. It's in a strong uptrend. I know it's tiny and small to see. But this was a $3,600 winner. Could have been 7 or 8 grand if it had gone 6 cents more. Right? We had a $2 stop loss and a $4 target. And 6 more cents cost me, $4,000. But that's not the point of the slide today. The point of the slide is to look and say, wow, look how beautiful this thing is. What's this? Meta, Facebook, whatever you want to call it. It's a little bit older. Note right here. In fact, you know what? Let me do it this way. Make it easier for you guys. Okay? This right here, give me a second. Whoops, wrong piece. Right here. That is pre-market. That pink area is all pre-market. All right? That pink area is all pre-market. Okay? Pre-market, 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 pre-market. Pre-market. All pre-market. Let's move it away. Okay? Look at it. Notice yesterday. See the double top? Here, let's do this again. See this area right here? There's some junk here, right? Topping tail, pivot, topping tail, pivot, pivot. Guess what? The pre-market's above all that. It's above all that and it's staying right there, staying right there, staying right there, staying right there. Boom. Now, granted, this stock may have given you an opportunity on this pullback, but the early aggressive entry at 199.75 went to 201. Now, is that a huge move? No, it's only $1.25, but it was only a 60-cent stop loss. Okay? It's only a 60-cent stop loss. So it actually went 2 to 1. And then it chopped around and didn't actually stop out and then went back to the high. All right? But the point is look at the beautiful consolidation. Look at this bar right here. Guys, you got to realize this bar started at the bottom and closed at the top. That's some commitment from the buyers. Okay? There we are trading it. There we are trading it right there. See the consolidation, guys, on the 5-minute right there? Beautiful. See that get really jiggy off the open and then rip? 931. Facebook, 199.75 by 199.15. That is how you trade it. You could have waited a little longer, right? You could have waited for, actually, no, we took a great trade, actually. You can see even the 2-minute, 199.75. It's the same spot. See the 15-minute, guys? Look at it right there. See the 15-minute? Right there. Right there. Right there. Right? So, that's the pre-market phase. Now, here's another one. FedEx. This is post-market on the left. Post-market on the left. Pre-market on the right. You can see the line. See the dividing line right here? Okay? We can put a line there if you want. Make it easier for people. That's the daily dividing line. Okay? That divides from the post to the pre. It was strong in the post-market. It continued to strengthen the pre-market. Okay? Stayed in a tight range. Now, note, this is a 5-minute chart, so we waited a couple minutes to get into this. Right? We waited a couple minutes to get into this. And then it ripped. 165 is the area. Nibble some in the pre. Give it room. Guys, if you see something this tight in the pre-market, this is why you take 1/3 to a half, because then you're able to give it down to 163. You're able to give this thing tons of room. And then when the market opens, if it does give you that little mini shake, you add and get full to it. And then you put your stop under the mini shake. I want to be clear about what I just said, because it's the only way to trade these. One, you nibble 1/3 to a half lot in the pre-market around 925 to 929. Don't get in too early. Don't get in at 910. Wait for 925 to 929. Nibble 1/3 to 1/2. Give it a super wide stop. Like in this case, down to 163. And when the market opens, if it gives you a little bumble, like it pulls back a little bit, when it retakes 165, get full and put your stop under the low of the day. So let's just say the first minute or two of the day, this thing goes all the way down to 164.40, okay? Then comes back up to 165. You go full, put your stop 10 or 20 cents under the low of the day. Done. Now, some of you are thinking, well, what if? What if it doesn't do that? Oh, well, if it just literally hits 165 at 9:30 and just goes, at least you have a half lot, right? At least you have a half lot. It's better than nothing. Most of the time, they'll wiggle just a little bit and then rip. And that's exactly what FedEx did here. Wiggled a little bit and then ripped. And this thing ended up going about, what, $3.50 on less than $1 stop. Okay? And it's not hindsight. It's not Monday morning stuff. 925, FedEx over 165. 931, FedEx 165. It's not hindsight. We took the trade. Right? There it is. There's the trade. Okay? Guys, watch FedEx over 165.50 for an ad. Okay? Stop would be raised to 164.95 if the ad triggered. These are all the things you're thinking pre-market. What would I like to see happen? Jordan does it all the time. Do you ever see Jordan C in the room? He puts in a chart all the time. This is what I'd like to see happen. Why do we do this? So that if and when it does happen, you're completely and totally ready for it. You're ready for it if and when it happens. You're not holding your, holding your, you know what. You're ready to pounce on it when it happens. Okay? Now, here's another example. Enter as soon as the stock breaks above 38. That might be 1 second into the trading day or 10 minutes into the trading day. Why do I like this so much? Because of this bottoming tail. And then it holds this area. So again, this is a stock late. 928, 927, 929. Nibble, nibble, nibble. 38 nibble. Stop. Shit. right under this pivot probably, 36.75. You're like, Jared, that's a wide stop. I know, but I don't want to get shaken. And usually they give you a little bit of an opportunity, 30 seconds, a minute into the day where they pull back, and then I get full over 38 and I put my stop at like 37.25. This one's too tight. I wouldn't put it that tight. I would put the stop loss here. In fact, let's move it. Right? That's what I would do. Okay? I would put the stop right there just to be safe. And what did this thing do? Guys, it went from $38 to $40 in the first 5 minutes of the day. 38 to 40 in the first 5 minutes of the day. That's a $2 move on a 75-cent stop, like 2.6 R. And it ultimately did better than that, but that's not the point. See the shake? See the pivot? See how it's staying in this range? Very important. On the downside, now, this one ended up being really juicy because it ended up giving you a really nice pattern on top of it. So you had a beautiful pre-market. Now, why am I showing you this? I'm showing you this because sometimes the pre-market is nice, but it's not perfect. And this is a great example. This is a nice pre-market, but it's not perfect. This is one I might not nibble in the pre-market. I might wait for the market open. Or I might wait for the market open and set an order at 36.50, right? If you see this, you can see the 36.50 area right there all the way across, right? 36.50 all the way across. So you can see down here, it tested that area, retested that area, and then when the market opened, it just slightly below that area. So when the market opens, you might say, you know, I'm going to take a third lot at 36.50 before there's a pattern there. I'm going to put my stop loss way up here, way up here. But then when it finally gives you the pattern, then you can get full. But take note, this stock gave you the pattern in the pre-market. Take a look. Take a look at the timestamp. This big, huge volume spike is 9:31 in the morning, or 9:35, sorry, my bad. So note, this red bar, this green bar topping tail, that's all 9:25. This is a 5-minute chart, so 9:25, 9:30. So this is one you actually could have taken at 36.50 in the pre-market. Half lot, third lot, put your stop at 37. When the market opens, if it gives you an opportunity, which is right here, note, real quick, note, see how jiggy that got? See that right there? See it? Right there. It's super jiggy. This is why you want a wide stop. What if this thing pops back up a little bit? Now you know that's the high. Right there. You know 38, 36.50 is the high. Put it a little bit above that and you're gold. And this thing goes what? $2.40 on a 20-cent stop? That's 12R. Now, this slide is in Professional Trading Strategies. This is what it looks like with the pre-market. With the pre-market. Okay? Chop, 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 chop. This is the gap. This is the pre-market. Now, hold on. You guys are looking at this going, hey, you know, not bad. Not bad. The stock was $76 at 8 a.m. And by 9:30, it was $55. $76 at 8:30. And by 9:30, at $54. So you guys are agreeing with me. Yes, Jared, we agree with you. That is climactic. Guess what? This is what most of you see. That's what most of you see. Because you look at the pre-market. You just see a stock that gapped from 74 to 54. So going long on this might be pretty difficult. For me, I'm looking at this going, if this thing pukes out off the open, I will be long all day, every day. If this thing pukes out off the, which is to see the big volume spike at the bottom, that's the open. That's the open, 9:30. And it sells off to the tune of like $3 or $4, about $4. Going long, baby. Guess what? Guess what? It's so much easier to have confidence to take this when it looks like this, isn't it? Tell me I'm wrong. When it looks like this, you look at it as an actual climactic play. But when you cover up these red bars, you're like, Jared, you're just buying the low? You're going long on the low? Are you crazy? It hasn't set up a pattern yet. Yes, it has. And it's done it on tremendous volume. Each one of these pre-market bars is 1 million shares. See the little bars down here at the bottom? They're 1 million shares each. It's done 3 million shares before the market ever opened. I'm following the money. I'm following the institutions. So you guys are all looking at this chart and it looks like this. I just see a gap down. Is he crazy? You guys are whispering amongst yourselves. Is he nuts? Is he crazy? Has he lost his mind? He's literally just randomly buying the low? No, I'm not randomly buying anything. I'm looking at the pre-market climactic buy setup, and I'm getting in over this green bar and putting my stop under the low. It's like a $57 entry with a stop at like $55, and it goes to $66. $11 move. Using the pre-market allowed us to see the 15-minute pullback more clearly. In this case, parabolic. Parabolic. Use the pre-market. Another example. Use the pre-market. Hanging out, chilling out, from 6 a.m. to 8 a.m., 4:30, 4:30, 4:30, 4:30, 4:30, 4:30. Just hammer it off the open. Nibble a little in the pre-market. Put your stop at 432, maybe 433, maybe. Give it some room. I always suggest if you're going to take it in the pre-market, give it extra room and lower shares. So you have both. You're double protected. Wider stop, smaller shares. Then when the market opens, then you can start getting full. This stock dropped from 430 to 417, $13 on a $2 to $3 stop loss. Gold. Now, few more slides and we'll wrap this thing up. Waiting. When should you wait? When is it not okay to just hop in these things? Well, it's actually pretty simple. When there's no pattern, when there's no good pre-market, despite stalking this pre-market due to the excellent gap and the nice pre-market chart, we weren't able to get a quality entry until later. Lesson, if a stock has a nice gap, do not take it off your list. Be patient. Not every trade triggers exactly where we want it to. Now, there's two scenarios here. Scenario one, it had a nice pre-market chart. I apologize, genuinely apologize. I didn't have enough time to put this on. I was rushing to put this lecture. I was literally, you know why I was quiet today in the chat room? I was putting this lecture together, literally. That's why I didn't post anything for like 30 minutes. Anyway. You could have nibbled some at 129, 128 in the pre-market, half lot, extra room. Maybe it held. Maybe it stopped. Maybe you nibbled some in the pre-market and gave it room, and maybe it wasn't enough. Maybe you nibbled some at 129, you gave it room to 127, and it tagged you. Okay, shit happens sometimes, and that sucks. But what I want you to note here is bottoming tail, 3-bar play, but it never triggered. And then it keeps going lower, but buyers are stepping up. Keeps going lower, but buyers are stepping up. Keeps going lower, but keeps going lower, but buyers. You're getting the theme here? It keeps going lower, but buyers keep leaving their impression. What does this tell us? At some point, this thing is going to pop hard. Buyers are stepping up here, but it went a little lower. Buyers are stepping up, it went a little lower. Buyers all the way down here. And even on the one concerning red bar, this red bar is concerning, the next bar was an engulfing bar. Buy it at 127.45, put your stop at 126.25, then goes to 132.50. Money. So even if you took some pre-market and it didn't work, because it happens, you get back in. You could add over here. Money. And if you didn't stop in the pre-market, this is a great entry. Same here. Here's a stock that, despite a nice pre-market, just didn't do anything. It just dropped, right? It did. Maybe you stopped out. In this case, I didn't buy it in the pre-market. I did not buy it in the pre-market, okay? But this stock pulled back, bounced, retested, comes back up, and then gives this beautiful entry. Honestly, you could have got in at like 332.50, right where my cursor is. You could have gotten in right there. Okay. One scenario to wait is when the gap with the pre-market consolidation is to the upside, for example, but markets are opening. Yes, I agree with you. Pre-market charts, guys, are very important for me. Unwell doesn't use them very much, but if I see a stock, for example, if I see a stock rip 3 or 4 bars up right before the market opens, I won't take it off the open. Let me repeat myself just in case you got confused. If I see, and let's just put a little picture. For example, okay? If imagine, hypothetical, these 3 bars are pre-market. Imagine these are pre-market, and the market opens. I'm not buying that high. There's no way. I'm not buying that high. It just moved from 333 to 335. I'm not buying the high. You need to give me a pullback, a consolidation, something in the pre-market so that I can feel comfortable the stock isn't already extended. All right? So in this case, the stock gave a pullback to the moving average, a pullback to a little bit of support. It bounced, it retested, it bounced and gave us an entry at 333, and 332.30 is a very tight stop loss. Okay? This was a quick $1,400 or $1,500 winner, but this was very aggressive. I should have been in at 332.50 with a stop at 331. I'll repeat myself. I should have been in at 332.50 with a stop at 331. Either way, the stock did go to like 336.50. Not bad. Okay? Now, regardless of how nice a gap is or how much we like something, we never just randomly buy it. We must always have a pattern. Now, let me explain this for a second. Those pre-market consolidations on volume, and that's key. I went over every one of these things. You guys remember? Let's do it for a quick second. Do you guys remember? We talked about this slide. So you can't say I didn't talk about volume today. I told you every one of these stocks has uniquely high volume. Unusually high volume because it means institutional commitment. So we got the volume out of the way. After we got the volume out of the way, we also got the beautiful pre-market chart out of the way also. And in many cases, not all, but many, a nice shakeout, bottoming tail, retest, something of that nature. So we got the volume out of the way, which is very important. We got the pre-market chart with a nice gap out of the way. Okay? Very important. So you can't say there was no volume. You can't say there wasn't a pattern. We had a pre-market pattern with volume. The only time that you are allowed, without a great pre-market chart, to take a 1-minute high is a level 1 gap. That is the only time PTS allows you to get into a 1-minute high using the high of the day entry, low of the day stop, without a good pre-market chart, is on a level 1 gap. And even then, you still need the volume. Okay? And yes, this stuff does happen early and often, and you see it on Amazon recently. You see it on NVIDIA recently. So while, yes, they can be somewhat more aggressive, when they are doing volume, okay, when they're doing volume, you're looking at these as almost as if the market is already open. And this is why I don't want to take a pre-market chart that has no volume, because the institutions come in later at that point. I want the institution showing their hand, already showing their hand in the pre-market. I want them hinting, guys, we're buying this one early today because we really like it. Great. Thanks for the information. I'm jumping on your tail. I'm not going to ever get in front of you. I'm just going to jump on your tail. And because the market isn't open yet, we're not doing a full lot. We're doing a half to a third to a half. That's it. Okay? So I go back to this. Regardless of how nice the gap is or how much we like it, we never randomly buy it. We always have a pattern. Make sure it has volume. Make sure it's a good pre-market. And make sure the gap is nice too. And double check the market conditions too. You might have a great pre-market chart, guys, on a nice gap, on volume, and the market's up, gap's up $7, $8, $8. That's tough. That's tough. So you still have to look at market conditions as well. All right, so I'm Jared Wesley of Live Traders. I hope you guys learned a lot about using pre-market charts to make money early in the day. You can be done in 15 minutes potentially if you have the right pre-market chart with the right volume, the right gap, the right bottoming tail shakeout. You nibble some early, get full after the market opens. There's a lot there. You have to be good with order entry and execution because things happen quickly. They're very whippy off the open. This is not something that if you're brand new, I would recommend. You better have your order entry down and you better be able to place a stop loss quickly because things happen very quickly at that time of the day. So it's not for the faint of heart, but if you get good at it, you can really get an edge up on a lot of other traders by nibbling a little in the pre-market and then maybe adding and getting full after the market opens. So I hope that lecture was helpful for you guys. I hope it will make you a lot of money. I'm Jared Wesley of Live Traders. We'll get back at it again next week.